video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and we are one day out from the rate cut decision. I am going to be going live for FOMC. As we approach these rate cuts, I am seeing a whole heap of very bad takes. So I thought I would just touch on a couple of these because these seem to keep getting parroted around. I did the same thing with all gaps fill and I kept saying it doesn't make any sense, just Google it. And the two I'm seeing at the moment are, this is the most telegraphed recession of all time. And then the other thing is that 50 basis points will cause the Fed to panic, and I'm seeing a whole heap of bad takes. But whilst this one is a little bit more speculative, this one is very, very simple. You just need a little bit of bond market knowledge. That's all you really need. So I'm going to explain the whole rate cuts thing, bullish, bearish implications, and cycles as always. But before I do, I wanted to talk about this being the most telegraphed recession of all time. A lot of people right now have just had enough of the recession callers. And to be frank, I understand completely because people have been calling for a recession every 6 weeks since the last recession, right? The whole way up, people have been doom posting fractals. Oh, recession is coming, recession is coming. And the reality is we live in this attention economy. I can tell you for sure, fear sells. I think we all kind of know this intuitively anyway. And if you want to game the system to get the most amount of views, attention, and subscribers on your channel, then the way to do that is to consistently post doom fractals. If I was to grab this fractal here, say, and then stretch this thing out, I'm sure you've seen this as well. The whole way up, people have been saying, this is what comes next, right? This is what comes next. This is what comes next. This is what comes next. I'm sure we've all seen it, okay? There's just accounts that this is what they do. They post a doom fractal and then they get invalidated and they just move the fractal up and they get invalidated again. And so when I was talking about differentiating between the people you should maybe pay attention to versus the ones that you should ignore, the people that just doom post fractals all the time and have been on the wrong side of the trade the entire way up, okay, I don't think we need to pay attention to when those types of people are calling for recessions. Again, I respectfully ask that you don't tar me with that same brush, okay? Because whilst I have been saying I see a recession not too far away, okay? Remember, I've been long and strong the entire way up. Also remember, at the lows, I was calling for a blow off top to new highs. I also called for a left translated Bitcoin cycle and an all-time high before the halving, and I am still calling for 100k plus Bitcoin, potentially by the end of this year. So I still remain, if anything, overly bullish, right? But again, my analysis, the weekend's deep dives, all of that kind of thing tells me that we are seeing deterioration in the economy right around the time we'd expect to see it. And if we do get a third and final angle, perhaps catalyzed by rate cuts, how do you think that thing is going to end? I think it's going to break down and then we'll be able to go back and the NBER will do what they always do, which is declare the recession about a year after the fact. And so by the time we get into the middle of next year, they might well sound the alarm bell and say, we think we've been in recession since the middle of this year. But remember, they did that in 2008, okay? In 2008, in December, right around the red line here, that's when they announced the recession officially, okay? And they went back and said that the recession officially started here in December, a full 12 months prior. So could we see the same thing again? I think we could, okay? And waiting for everyone to be officially told they're in a recession is not really a good strategy. So when it comes to this being the most telegraphed recession of all time, I think that's the first point to make, okay? I think there's nothing wrong with calling for a recession, but there is a problem when we're not long and strong during a big, powerful uptrend, right? So that's the first thing to watch out for. The people that post the fractals and everything's on fire every single day of the week and yet the market just keeps screaming higher. Those people, I don't really think they've got any weight in their words, right? Their opinion doesn't matter because frankly, they've just been on the wrong side of the trade the entire time. And really, the only reason they do the kind of things they do is because, like I said earlier, fear sells, okay? They just want your clicks, they just want your attention, they just want your subscriptions. And that's ultimately because they've been on the wrong side of the trade. They need the money, right? They've not been making money on the way up. So that's the first thing. The second thing is, if we look at Wall Street, only 11% of Wall Street analysts have recession and hard landing as their base case, right? The remainder, nearly 90% of the people on the street have no landing or soft landing as their base case. So what that tells you is this is actually not the most telegraphed recession of all time. Yeah, you might look on Twitter and see nothing but doom posting. That is because fear sells. Those accounts are gaming the system, panic, doom fractals, all of that stuff is how you get clicks, likes, attention, and subscriptions in this game. But in terms of this being the most telegraphed recession of all time, it's actually not. 90% of the people who matter, the institutional analysts, have no landing or soft landing as their base case, and only 11% of them have a recession as their base case. So to be a recession caller at this moment in time is to be highly contrarian. And I know it might not feel like that when you look around on Twitter. Believe me, I see it as well. But we have to be able to differentiate between those people that are just garnering attention versus those people that actually have some kind of respectable stance. Okay, the people on Wall Street are managing a lot more capital than those doom posters that realistically are probably not even traders. And one last point to make on this bit, and this is the most important of all, recessions pertain to the economy, right? They pertain to the economy. So we can have a recession. We could already have been in one. I'm pretty sure that when the NBER go back, they're going to tell us that we've been in recession since roughly the middle of this year. I'm pretty confident that's what's going to happen, just like I showed you with 2008 when they declared the recession a full year after the fact. But just because somebody like me believes we're heading into an economic recession, really, if you think about it, it doesn't mean anything. What matters is being able to call or predict a recession does not equal being able to make money in markets, okay? If you were a doom poster this entire way up, if you were doing nothing but post those fractals and you were short or you were sidelined waiting to buy a big recessionary crash and all of this kind of thing, okay, you missed what was a 60-something% rally from the lows in about 2 years. Less than 2 years, okay? That's what you missed out on. And the same for Bitcoin, you know, the people that doubted that a left translation was even possible, the people that said it's never made an all-time high before the halving, they missed a 250% rally off the lows, and then they bought the top, and now they're crying that they're down 25%. So in terms of this, you know, I think it may well seem like it is telegraphed, but under the hood, it's not. It's completely normal and to be expected that all of Wall Street are offside because they are not in the business of picking tops and bottoms. They are trend followers. That's what they're mandated to do. They find a trend, they stay on it until it tops and breaks down, and then somewhere in here, they get short. Okay, and then the same for the bottom. They stay short until this thing reverses trend, and then again, they hop on the trend. That's what they do. They're not in the business of picking tops and bottoms. They're trend followers. And right now, they've been following a trend which has been the correct stance. To be long and strong has been the correct thing to do. But simply saying we're not going to have a recession just because your Twitter timeline is full of doom posters is frankly just to ignore all of the data under the hood, which continues to deteriorate right around the time we're seemingly having these blow off top moments at the end of the longer term cycles. So just something to pay attention to. Again, okay, you don't have to believe we're going into a recession. You don't have to believe a word I say. In fact, you shouldn't believe a word I say. You should just do your own thing and think for yourself. Of course, that's the only way you're going to make it. But it is, in my opinion, a waste of time to sit here and say this is the most telegraphed recession, so we can't have one. Meanwhile, we've got a yield curve that's record inverted for record amounts of time. We've got Fed policy, which we're going to go through now, which is over tight. We've got inflation dropping like a stone and everyone thinks it's sticky. We've got unemployment deteriorating rapidly. Things like the SAM recession rule, flashing recessionary tendencies amongst a whole heap of other recessionary indicators also flashing. And at the same time, we've got the Fed out here lying to everyone, pretending like the data's fine, okay? Quietly revising it down. We've got Sam coming out and saying, no, this time's different. My recession trigger doesn't count this time, only to 6 months later come out and say, actually, yeah, the labour market deterioration is real. We're probably going to be in a recession if the Fed doesn't cut. Our job, really, is not to worry or stress or put emotions on a recession. It's just to pay attention to the data and stay on the trend until it breaks. And then the next thing I'm seeing is a whole heap of this, okay? They can't cut 50 basis points because the Fed will cause panic. Now, this one is not speculative. This one is actually very, very black and white. It's just, for some reason, people are lazy. They like to parrot stuff they see online rather than do their own research, rather than actually take some time to study the bond market and all of this kind of stuff. And if you think that take is bad, have a look at this. No way we get 50 basis points without stagflation. I mean, what are you talking about? This doesn't make any sense whatsoever. So here's the facts, okay? Senator Warren is calling for a 75 basis point cut by the Fed this week. And again, a whole heap of people are saying, no way, they can't do that. So far, it's not priced in, okay? But we have noticed pinged around by another 20 or 30% since yesterday's video. And we're now expecting 67% probability of seeing a 50 basis point cut. So why then is it so easy for me to dismiss all these people that say they can't cut by X amount because it will cause panic? Why is it everyone's wrong? People do not understand the bond market. If they knew what they were looking for, if they knew where to look, they would know that the difference between the Fed funds rate and the 2-year yield is how far behind or ahead of the curve the Fed is. Here's Foss. If you don't know Foss, he spent 35 years in a risk chair and was a large credit trader, okay? It's not rocket science. Whilst everyone is talking about 25 or 50, okay, think outside the box. Rates need to decline by 160 basis points to match the 2-year treasury yields. So again, whilst everyone is sat here saying they can't cut by X because it will cause panic and fear, and it will show that they're scared of a recession. They should be scared of a recession because the economic deterioration is happening right before our eyes. We've got all this other stuff like the yield curve, as I said earlier, and the SAM recession rule, and unemployment deteriorating, and inflation dropping. Okay, they are behind the curve. This policy is too tight. And how do we know? Because the gap between the Fed funds rate and the 2-year yields is 160 basis points. It's not supposed to be that big. So if they come out and do a 25 basis point cut, okay, they are still going to be massively behind the curve. If they come out and do a 50 basis point cut, they are still going to be over 100 basis points behind the curve. Now do you understand? Okay, it's not that hard. The gap between the Fed funds rate and the 2-year yield is how far or ahead of the curve they are. They are massively behind the curve right now. This is why Elizabeth Warren is asking for a 75 basis point cut, because even after a 75 basis point cut, they're still going to be over 75 basis points behind the curve. The Fed is far, far, far too late to cut. It should have cut in July, but it has dug its heels in. So is this a controlled demolition? Here's how I'm looking at it. Okay, if we see a 25 basis point cut, I am going to say that I am 100% correct in my assessment that this is a deliberate controlled demolition. If they dig their heels in, and whilst they're 160 basis points behind the curve, only cut by 25 points, I am going to be 100% convinced that they are deliberately engineering a deflationary shock, a deflationary meltdown and a crash. And this is actually the most bearish that we could go, okay? The more they cut rates, the closer they can get the gap between the Fed funds rate and the 2-year yields, the more I will say that I am wrong about this being a controlled demolition. They do a 50 and I'll say, okay, they showed a little bit more maturity than I was expecting them to. Okay, they recognize they can't do a 25 without everything blowing up. At least they've shown some maturity. And if they're to do a 75 basis point cut, which currently is not priced in at all, then I would say I am absolutely wrong, to the point where I owe the Fed an apology for accusing them of trying to engineer a collapse, when in fact, doing a 75 basis point cut would show that they recognize how far behind the curve they are and they don't want to destroy everything. And so that's the black and white reality, okay? They are 160 points behind the curve. You can tell that because that's the gap between here and here. That's why I've spent so much time focusing on this chart. So many memes have been made. Tell that to the bond market, okay? Because this is what's important, not parroting everyone's ideas on Twitter about 50 will cause panic. And this rule is as old as time, okay? Just fire the Fed and use the 2-year yield. Again, they're 150 points behind the curve, and this lags 18 months. The Fed is incredibly late. Something else worth pointing out here is notice when they're late, when they're behind the curve, and they start cutting, they are forced to do emergency cuts as quickly as they can to try to get back in line with the curve. Which means the less they cut this meeting, okay, the quicker they are going to have to start to panic cut to catch up with the yields. Either way, these yields are going to continue to move down. Why? Because they know at the onset of a cutting cycle, this thing's not going to stop. So the yields are going to continue to come off. The bond market is going to continue to tell the Fed how late it is. And therefore, the less they actually cut, the more they're going to be forced to panic cut later in life. And panic cutting signals to the market that the Fed has lost control. Something else that's really important to point out here is whilst effective Fed funds rate lags revolving consumer credit to the upside, it leads to the downside. And this cycle looks especially bad because the declining revolving consumer credit is actually front running the Fed here. This is how effed up this situation is. This is how behind the curve and late to cut the Fed is, okay? Even revolving consumer credit is starting to dive off a cliff, starting to front run this onset of a cutting cycle, which normally has big recessionary tendencies. So again, it's not crowded or telegraphed to say this is a recession and it's going to be unfolding within the next few months. We may already be in one when the NBER go back. It's not crowded to say that. It's just simply looking at data and saying unless things change very, very rapidly, okay, then it's going to continue. So how many people do you see saying things like the more they cut, the more bullish it is? Because I don't see anyone saying that. All I see is they better only do a 25 or everything's going to explode. All I see is people saying they can't do 50 because it will cause panic. When if anyone knew what they were talking about, they would know about this, okay? It's not a coincidence that the people that know what they're talking about, the people that have spent 35 years in a risk chair are all saying the same thing. Meanwhile, your favorite LARP on Twitter is telling you 50 basis points will cause panic. So you can sit here and say all day that you don't believe a recession's coming and they better only do a 25 basis point cut. But again, I sit here and say, tell that to the flipping bond market. So what does all of this mean for charts? Let's just pop into a couple of charts here because as ever, okay, all of this stuff is really narrative. Yes, they could be over tight. Yes, they could only do a 25 basis point cut, blah, blah, blah. And yes, most people will trade the tape on the day, right? So if we get to tomorrow, whatever the cut is, it doesn't matter whether it's 25, 50, 75. If the market rallies, then the market will explain away that price action with whatever narrative fits. And if the market sells off, okay, on a 25 basis point, they'll say, well, they're already too tight. Oh, it turns out they should have done 50. If they do 50 or 75, the narrative, if we sell off, will be, well, that's because they've caused panic by signaling a recession, okay? But remember, what happens on the day or the following day or the following few sessions is kind of irrelevant, okay? Because the chart is the truth, the charts don't lie, and cycles are in control. And what traders and investors always do is invent a narrative to explain away the price action. If we rally out of here, okay, and then find a cycle low, you best believe the narrative is going to be that the rate cuts are bullish, right? When really all we would have done is found a cycle low, a half cycle low, a cycle top, and another cycle low, okay? Normal cycle behavior. And if from here we roll over and find a cycle low, whether it's here or all the way down here, okay, again, the Camel Crew has known that cycle low has been coming, and I've been talking about this over and over and over again since the last cycle low. Just like we were talking about this cycle low since the last cycle low, and you know how the deal goes, right? That's what we do here. We find the cycle lows. So really, it doesn't matter what the narrative is. It doesn't matter what the rate cuts are. What matters is where are we in the cycle? And as it stands, we are currently, as of today, going to be opening up on day 30. Now, we know that we get, typically speaking, around 40 days for a cycle low. And if this is going to be a very bullish cycle, that means we could expect a top on day 35 or 36, perhaps, somewhere in that neighborhood, which would put us out to about the 25th of September. And in the most bullish scenario then, 25th of September, cycle low, and hopefully one final hurrah. If, however, we've got a bearish scenario and a bearish reaction, and I'm not talking about tomorrow on the day, of course there's going to be chop, volatility in games as always. I'm talking about looking out to more than 1 or 2 candles, okay? We're not going to be watching 1-minute charts or 5-minute time frames. We're just going to let the dust settle, let the volatility play itself out, and then look for the weekly closes and how we respond next week. But even in the worst case scenario, a rollover here towards that cycle low time frame just tells us, as I've been saying over and over again, that this is the final cycle low for me to get behind before I start to look for and officially declare tops. So absolutely nothing changes to the base case hypothesis, nothing changes to the cycles, nothing changes to the way we handle this. And at the end of the day, whilst everyone is going to be zoomed right in, looking at the 1-minute candles, oh, it's bullish, it's bearish, I'm getting chopped up, I'm getting wrecked. The reality is, okay, if you just zoom out, give it a few candles of space, we're only going to have 1 or 2 scenarios here. We're either going to climb higher, cycle low, okay, and then we can add on that cycle low for the final time, or we're going to fall from here, cycle low, and then add from that cycle low for the final time. So it really is quite straightforward. It really is quite black and white. All of this occurring at a time when the majority of the market just has no clue what it's talking about. No clue whatsoever. The best thing most people can do is actually ignore the rate cuts and just use the cycles. If you completely ignore all of this, turn your screen off for Wednesday and come back on Thursday after the dust has settled, okay, that'll probably give most people the best chance. But of course they can't do that. They're going to be tuned in. They're going to be hanging off every word that the Fed says. They're going to be watching that candle ping around on the 1-minute chart, okay? It just is what it is. Most people aren't cut out for this. So that's interest rates, rate cuts, okay? We're going to be live tomorrow, so we'll deal with that. I noticed this yesterday, okay? BCB said, timeline is ghostly quiet about gold. And I said, look, another one, okay? Everyone is quiet about gold. It's one of the most crowded trades I've ever seen. Like I've been saying every other day, everyone seems to think that nobody cares about gold. Meanwhile, they don't seem to realize that the timeline is not ghostly quiet about gold. It's full of people claiming it to be ghostly quiet about gold, okay? Everyone has only started to notice this thing now. Nobody gave a monkeys when it broke out of here, okay? This was the time to pay attention to it. And only here, when we're into that weekly and yearly cycle high, does everyone start to think that suddenly no one's paying attention. So is a weekly cycle decline due for gold? Yes, I think it is. And is that historically bullish for Bitcoin? Yes, I think it is. But zooming out, okay, all dips are for buying. All cycle lows are for allocating, in my humble opinion. We are very, very early in this 8-year cycle. And the big picture remains unchanged, okay? Some kind of shakeout here, and then continuation of major upside towards the end of that 8-year cycle, perhaps a 1-year decline. And then we may even have another 8-year cycle to the upside from somewhere in this neighborhood, okay? So wild times for gold, huge markup ahead of us, but in the more short term, expecting some kind of shakeout because obviously everyone thinks no one's paying attention to this. And over in the world of Bitcoin, the Kingdom of Bhutan now owns 13,000 Bitcoin. Meanwhile, there's still a sea of triple top callers out here. Which means you're on team Peter Schiff, okay? Do you agree with Peter Schiff? Is this a triple top? Okay, I'm not convinced it is. And in fact, if we scroll down and take a look at this right here, this looks a lot more to me like a cup with handle. And this is Bitcoin priced in gold, by the way. Scope for major overperformance here in the Bitcoin to gold ratio. Global lick is about to explode. So it's not an if, but a when. Continuation of a push from here should yield much higher Bitcoin prices. Is this too bullish? Okay, or is something like this entirely possible? I'll leave it up to you. I'm not necessarily saying we could get all the way up to these insane numbers, but some kind of measured move from here would make a lot of sense to me, and that would put us at 150k-ish. If it falls slightly short or slightly beyond that, I'm not really too fussy. The big thing for me is, can we indeed get this squeeze, and can it occur into the end of the year for Bitcoin? Wild times to be alive, wild times to be trading through, that's for sure. As I said with the S&P, all right, we're long and strong, we're respecting the third angle until we're not. Okay, not going to make it overly complicated. We know we got a daily cycle low due in the last week of September, and we don't know the path yet, okay? So we'll let the market shake itself out. We'll let everyone trap themselves, focusing in on the small time frames and paying attention to the tape on the day of FOMC. And we're just going to do what we always do, okay? Step aside, let the dust settle, and then we'll come back and stay on top. Nasdaq's still yet to break out, so that's noteworthy. But the Dow, okay, working on this third and final angle, isn't it? New all-time highs for the Dow Jones. Very, very encouraging. Speaks to there being more gas left in this goose. The VIX is creeping up just a little bit, and that kind of makes sense. Okay, there's always going to be a bit of additional volatility around the FOMC since there is a great deal of uncertainty. Nobody knows what the Fed's going to say. Nobody knows how much the Fed is going to cut. And so a little bit of a VIX spike here makes sense. But then what I'm hoping to see is that final push down where we can actually get some hedges on. And the Russell 2K still kind of pinballing around, not doing a whole heap of anything. I think it wants to move higher, but again, it's kind of waiting for FOMC. Gold working on a half cycle low, I believe, so some kind of shakeout and then a resumption to the upside makes the most sense. And for Bitcoin, we're still looking to see if we can indeed leave this cycle low behind, break out, and most importantly, force a higher high. So no changes there. We'll see if we can get some kind of bullishness unfold. We might have to be open to seeing something more like this, okay, into the next cycle low window or the half cycle low, depending on which count you use, and then perhaps from there we can go into the end of the year. Of note, okay, tell that to the bond market, that's the 10-year yield still begging and screaming at the Fed to recognize how late it is to cut, okay? Still begging and screaming at the Fed to recognize its major policy error. Here's the 2-year yield. Okay, again, tell it to the bond market. And even the Dixie, okay, looks like it's working on a daily cycle failure here. Looks like it's not done yet, moving to the downside. Looks like that 3-year major low is in sight. How low down it goes is anybody's guess. Obviously, the lower it goes, the more likely we are to see risk absolutely skyrocket into those final blow off top angles. And then, of course, it should be deflationary bust time. So happy days there, I guess. I'm your boy Camel. I hope you're doing well. Until next time, take care from me. Cheers. Bye.
Camel Finance, he's the man to see, rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame, sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key, taking us normies on a bar.